Have you ever paused to consider the unseen forces, the hidden power structures maybe, behind your money? Or how a national institution, like a central bank, fundamentally changes when a bigger international one comes along? Today, we're taking a deep dive into exactly that. We're looking at the fascinating transformation of the Dutch central bank, the DNB, tracing its journey from the Gilder era right through to the Eurozone we know today. And our insights, well, they come directly from someone who was right there on the inside, someone who actually served on the board of the DNB. So our mission for you is pretty clear. We want to quickly and thoroughly help you grasp how the DNB's role has shifted, what that means for monetary policy, for bank supervision, and maybe more importantly, what it tells us about the bigger picture of European economic philosophy. Get ready, because we're going to uncover some surprising history and the real tensions still shaping finance today. Okay, let's pull back the curtain a bit on the DNB's past. Before the euro, back in the Gulden tide, as they call it in the Netherlands, you might think the DNB was this completely independent powerhouse, right? Setting its own monetary policy. But our sources, and I think our expert agrees, suggest it was, well, a bit more complicated than that.
Yeah, that's a common assumption, that the DNB was fully independent back then. But what's really striking is that from about 1983 onwards, its monetary policy wasn't actually set in total isolation. The Dutch guilder, you see, was deliberately coupled to the German mark, which basically meant the DNB effectively mirrored the interest rate policy coming out of Germany, set by the German Bundesbank, Germany's very powerful central bank, kind of the monetary anchor for Europe at the time. I remember it clearly. If the Bundesbank tweaked rates, maybe just a few tenths of a percent on a Thursday, the DNB would almost always follow suit very, very quickly.
Right. So this wasn't just market forces pushing them together. Our sources really stress this was a conscious strategic choice by the Netherlands. Could you maybe expand on why they did that?
Oh, absolutely. It was far from accidental. It was a very carefully thought out strategy. See, to keep that peg stable, that link to the German mark, the Netherlands committed itself to, well, disciplined fiscal policy. And they meticulously managed how wages and prices developed, trying to keep them in line with productivity gains. The big goal, really, was to avoid ever having to devalue the guilder against the mark. It was all about maintaining stability and, confidence.
That's fascinating. So the DNB already had this experience, this sort of external influence on its monetary policy, even before the euro, this alignment with Germany. It makes you wonder, how big a jump was it really for the DNB to then join the ECB framework?
That's a really insightful connection to make. If you look at the broader history, the collapse of Bretton Woods back in '71, when Nixon took the dollar off gold, that was a huge moment. After that, European countries sort of gradually drifted towards a system where the Bundesbank became the de facto leader. So even though it wasn't official, the Bundesbank was effectively calling the shots on monetary policy in Europe. And many countries, the Netherlands included, chose to follow their lead to keep their own currencies stable. So in a way, yes, the DNB was already quite used to operating in the shadow of another more dominant central bank.
Okay, so now let's shift gears to the arrival of the euro. January 1st, 1999. This is clearly a massive turning point for the DNB. And the big question, the one lots of people ask, is, did it just become a branch office, a filial of the European Central Bank, the ECB?
Well, when it comes to monetary policy, and that's the big stuff, setting interest rates, controlling money supply, yes. The DNB's role really did become purely executive. It implements decisions, the actual policy decisions. Those are now made in Frankfurt by the ECB's Governing Council. And this change also applied significantly to supervising banks, the really big banks, the ones over a certain size threshold. They now fall directly under the ECB supervision. I've seen it myself. The ECB sends these multinational teams to supervise major Dutch banks, like Rabobank, for example.
So for you listening, for the average Dutch citizen, what does this mean in practice? Does the DNB still do anything on its own, or is it just taking orders from Frankfurt now?
It's a fair question. And the reality is a bit nuanced. While a lot of the core functions are now executive, the DNB does keep some specific responsibilities. Smaller banks, for example, they're still supervised directly by the DNB, although even there, the framework, the rules for how they do that supervision are largely set by the ECB. But there are areas where DNB retains its own authority. A really important one is supervising the entire Dutch pension sector. That's still fully DNB's job. And they also handle assessing the suitability, the fitness and properness of bank directors. And in that specific area, the DNB can still apply its own rules. So no, it's not just a branch office. But its main role, its primary function, has definitely shifted. from policymaking to policy implementing.
Now, moving up a level beyond just the DNB, many people might not realize the incredibly dramatic and deeply political story behind how the ECB itself was even created. This wasn't purely an economic calculation, was it? It sounds more like a high-stakes geopolitical deal.
That's absolutely right. It's a crucial point to understand. Germany, especially Germany, had to give up far more monetary independence than the Netherlands did when the ECB was formed. The Bundesbank, remember, had genuine autonomy. It was widely seen as the gold standard, the leader in European monetary policy. And here's the really surprising history, the link people often miss. The euro and the ECB were essentially the price Germany paid for reunification. I remember that period intensely. Chancellor Helmut Kohl was determined to make history, to unite East and West Germany. And creating a single European currency was seen as a necessary political compromise to get France, mainly, on board with that reunification. Germany effectively traded its monetary sovereignty for national unity.
Wow, that's quite a statement. A price for reunification. And our source describes it as a real tug of war during the negotiations. Other countries, France being a key player, saw this as a chance, didn't they? A chance to regain some influence over monetary policy, which the Bundesbank had dominated for so long. So that begs the question, what did Germany fight for in return for giving up its beloved Bundesbank and its independent policy?
Well, Germany fought very hard to bake the Bundesbank's philosophy into the ECB's DNA. That philosophy emphasizing strong independence from politics, a very disciplined approach, and above all, an unwavering focus on price stability as the primary goal. They pushed really hard to get this embedded in the Maastricht Treaty, the ECB statutes, and they also insisted on those strict convergence criteria for joining the euro. Limits on government debt, on deficits, on interest rate levels. They saw these as absolutely essential guardrails for the currency's future stability. There was also a big fight over the start date. Germany initially wanted to wait until all the criteria were properly met by enough countries. But France and others pushed for a fixed start date January 1st, 1999, as long as a core group qualified. And that latter, more, shall we say, politically driven timeline won out in the end.
And for a while, it looked like a roaring success, didn't it? For many years after 1999, maybe up until around 2011 or so, the Eurozone actually saw pretty low inflation, sometimes even falling inflation.
Yes, absolutely. In those early years, it was widely seen as a major success story. And, from my perspective back then, there was a real sense of accomplishment. Central bankers globally, including at the ECB, often pointed to their sound policies as the reason for this low inflation. But looking back, we also have to acknowledge the huge role of external factors, specifically the rise of China. It joined the global economy in a big way, and the sheer volume of low-cost goods pouring out of China put massive downward pressure on prices globally, especially for industrial goods. Still, as you compare the Bundesbank's historical average inflation, maybe around 3% over its 50 years, with the Eurozone achieving roughly 2% on average in those first 10, 12 years, it really did feel like a fantastic achievement considering the scale and complexity of launching a new currency for so many countries.
Okay, so the honeymoon period, if you like, seemed good. But then, underneath the surface, particularly during the global financial crisis and then the euro sovereign debt crisis that followed, real cracks, real frictions started showing up. And maybe the most controversial policy to emerge from that was quantitative easing, or QE.
QE. Yes, that became hugely controversial. Essentially, QE involved the ECB buying up enormous quantities of government bonds in the market, which, critics argued, effectively amounted to financing governments indirectly. And this flew directly in the face of that core German and Dutch philosophy, that strict principle against central banks directly financing governments, what's often called monetary financing. Now, technically, the ECB statutes do forbid direct financing. Like, the ECB can't just give money straight to Italy or France. But there was a provision allowing the purchase of existing government debt in the secondary market. Think of it like this. The rule says you can't buy a brand new car directly from the government factory, but you can buy that same government's bonds, like used cars, from investors in the open market. Originally, that secondary market tool was meant for, maybe, fine-tuning things subtly, not for these massive sustained purchases that effectively propped up government borrowing. That's where the philosophical divide really blew open.
So what does this mean for you listening at home? This shift effectively led to something our source calls budgetary dominance. What exactly is that?
Budgetary dominance is when government spending decisions, fiscal policy, become the main thing driving inflation, rather than the central bank's actions. Imagine the central bank is trying to manage the economy's temperature with a thermostat that's monetary policy. But if the government is running huge deficits and spending massively, it's like leaving the oven door wide open next to the thermostat. The government's actions overwhelm the central bank's ability to control the heat, the inflation. And the key implication for you, the citizen, especially in certain countries, is that nations with very high government debt become incredibly sensitive to interest rate hikes. If the ECB needs to raise rates to fight inflation, it hurts high-debt countries like Italy or Spain much more than lower-debt countries like the Netherlands or Germany, because their interest payments on a huge pile of debt just explode. And this creates constant tension inside the ECB's governing council, believe me. Having seen some of these debates unfold, they weren't just abstract economic discussions. They touched on deep-seated national principles, historical fears. It could get quite heated. You'd see some members, often from countries with higher debt levels, they might lean towards keeping interest rates lower for longer, perhaps prioritizing financial stability over hitting an inflation target exactly. Even if that risks inflation staying a bit higher, which, by the way, also helps erode the real value of their large debts. While others, typically the German and Dutch representatives, consistently argue for caution, prioritizing price stability above almost everything else, true to that Bundesbank heritage. You see this playing out right now, actually. Inflation's around 2%, interest rates are also around 2%, give or take. And there's this big debate, should we cut rates further? Those pushing for cuts often represent countries that would benefit from lower borrowing costs. While those urging caution worry about reigniting inflation down the line, it's a constant balancing act, reflecting those underlying differences.
So connecting this all together, it really does seem like the original vision for the Eurozone, that convergence towards a German model, might actually be reversing. That's a profound thought.
It is. It's a very powerful observation from our source, and one that resonates with my experience. The initial idea, the promise of Maastricht, was that everyone would gradually adopt that disciplined, stability-focused approach, the Bundesbank way. But what we've actually seen over the past decade or so, especially since the crises, is arguably the opposite happening. Germany and the Netherlands feel like they're being pulled towards the philosophy more common in countries like France or others in the South, where there's perhaps a greater tolerance for inflation or more focus on using monetary policy for broader economic goals beyond just price stability. And for those who value that original, more conservative approach, this shift is not exactly welcome. It feels like a fundamental change in the Eurozone's character.
We've definitely covered a lot of ground here, a really complex and, as we've heard, surprisingly political journey. From the DNB in its pre-Euro days, kind of operating in the Bundesbank's orbit, to its transformed role as more of an executive arm within the ECB system, and then the intricate, high-stakes political deals that actually created the ECB in the first place. And we've seen how recent policies like QE haven't just been technical adjustments. They've really ignited these fundamental clashes about the very philosophy of money and debt within Europe, subtly shifting that balance of power.
Absolutely. And I think having been close to these events, perhaps the biggest takeaway is this. These decisions about central banking, which can seem so technical, so dry, they're always deeply intertwined with politics, with national histories, and with competing interests. And they have profoundly real impacts on national economies and ultimately on your daily life, affecting everything from the prices you pay to the stability of your savings to the burden of government debt left for the future. Knowledge really is power here.
Which leaves us with a really important question for you, our listener, to think about. Given this history, the compromises, the ongoing tensions we've explored, what do you think the future holds for this balance of power in Europe's monetary system? Is a truly single, unified monetary philosophy even possible? Or will different national interests and histories always create these kinds of frictions?
It's certainly something worth pondering. There's always more to understand, different angles to consider. What this deep dive really highlights, I think, is that in the world of central banking, just like everywhere else, history, politics, and economics are tangled together in powerful and often quite unexpected ways. They continuously shape the financial world we all live in.